Welcome, welcome to Property, Plant, and Equipment. Now, at this point in our studies, right, we're 8+ sections in. At this point, you sit down and go, okay, how's my studying going? Is it starting to make sense? At this point, I also like to go back to maybe the first section and start to review a little bit, because it's easy to start forgetting the stuff we studied in section 1 and 2 and 3 and 4 and so on. But again, if you study, you will pass. This is not an IQ test. It's a test of discipline. So hang in there as far as putting in the hours. Remember to go through all the homework at least 2 to 3 times. Multiple choice, task-based simulations. The repetition is what will work. On the exam, you've got 1.5 minutes to jump from question to question to question to question. Repetition is key. Task-based simulations, my goal is for you to understand the concepts, so that way, no matter what format you see the question in, whether it's multiple choice or simulation problem, you will get the concepts correct. All right, where are we now? We're talking about fixed assets, property, plant, and equipment. We're going to talk about fixed assets under U.S. GAAP, all the ASCs, accounting standard codifications. Then at the end, we're going to talk about IFRS. Now, this is one of the areas where IFRS is significantly different than under U.S. GAAP. So we'll talk about differences, and I'll kind of drop a little bit of the exciting differences in there as I'm lecturing under GAAP, and then we'll hit them all at the very end. Now, property, plant, and equipment, we're looking at fixed assets, ASC 360. Basically, property, plant, and equipment, it's called PP&E, property, plant, and equipment, or fixed assets. These are tangible assets acquired for long-term use in the normal course of business. They're not for resale, and generally, they are subject to depreciation, right? One of the few things you remember from your college intermediate accounting class. Now, you're buying a piece of equipment, and what we're trying to do is when you buy it, instead of crediting cash for 100 and debiting expense for 100, we're trying to instead debit asset. So that's called capitalizing it. For tax purposes, what do you want to do? You want to debit expense, credit cash, right? Time value money. If I can take the expense today, woohoo, income drops, woohoo. What does that mean? I have lower income, pay less taxes, keep more money. For book purposes, it's the opposite. Our goal is to have less expense, so our income is higher, earnings per share is higher, net income is higher, and so on. So that's what investors are looking at. What is our bottom line number? So they would rather have the net income higher. So for book, what are we trying to do? We're trying to capitalize and then match the cost of the periods benefited using a systematic and rational, because we as CPAs are what? Systematic and rational, and we're totally cool. All right, so that's what we're trying to do as far as property, plant, and equipment. Instead of debiting the expense, we're going to capitalize the asset for $100. Then let's say it's going to live 10 years. We're going to have depreciation expense of 10, 10, 10, 10, 10, 10, 10. Why? Because we're trying to match the cost of the asset to the periods benefited. Because let's say, for example, I buy this equipment for $100,000 and it's going to help manufacture these pens. Well, I'm going to be selling these pens forever. This equipment is used for the next 10 years. Therefore, the cost of the equipment, instead of just expensing it today, what we'll do is we'll match it over the next 10 years. That's the concept of match net expense. So in order to do that, you need to capitalize the asset by debiting an asset and then match it over the periods benefited. For tax purposes, we'd like to immediately expense it. We have these things called a 179 deduction, and we'll learn about that in the regulation exam, and that allows you to immediately expense up to a certain amount of money if you're a certain size company. So if you're not a huge corporation, you're not Microsoft who's got billions and billions of dollars, you're a small company. Raj CPA Review, I'm buying $25,000 worth of assets. Can I expense them today, for example? So that's what we're looking at with a 179. Here, what we're going to do for financial accounting is we're going to capitalize and then match the cost of the periods benefited. Just like inventory, we're going to capitalize all the costs incurred in getting it ready for its what? What are the key words? Intended use. What is your intention? To get this equipment, to buy it, to get it shipped here, to set it up, to test it, to reorganize the shipping, the whole production line, to get it ready, and then use it. So all those costs up to that point, sales taxes and so on, are included in the acquisition cost. It says acquisition costs include all costs of acquisition or construction, as well as preparation for its use. Purchase price, legal fees, delinquent taxes, title insurance, transportation, again, that's freight in, not freight out, freight in, installation, test runs, sales taxes. All of that is part of the cost of getting it ready for its what? Intended use. Now, what about land? Why do we have to distinguish between land and building? Because here's my beautiful home, and here's the land it's on. Now, I don't know about where you live, but San Francisco, LA, Manhattan, boom, all of a sudden the housing market starts to pick up. Housing prices go crazy. So this is my half-bedroom, no-bath studio with, in San Francisco, and it's a bargain at $1 million, $1 million. Well, guess what? What am I paying for? This thing's broken apart, there's a hole in the roof and so on, but it's really the land, right? Because we assume for accounting purposes, land lives forever. Do we depreciate land? No. We assume it lives forever. Therefore, if I buy this building, and let's say I'm going to use this as an office. Okay, that's great. So I buy this building and I'm going to use it for an office. So can we depreciate it? Sure. And what would we do? We would offset that depreciation against the revenue being generated from the business. But if it's $1 million, let's say, for example, the building's only worth $100,000. That means the land's worth $900. Darn. What does that mean? It means that I can only depreciate this, not this. Right? That's why if you buy a building with land in a less expensive part of town or another city, I'm going to buy it in the middle of the Mojave Desert where it's 139 degrees. Okay? Well, therefore, I can get a beautiful, huge building and the land's not worth as much. So in San Francisco, it might be 20% building and 80% land, and in other cities it might be 90% building and 10% land. So notice that the more that goes to building, the more I can depreciate. So what we have to do is, let's say you buy a lump sum with the building and land. Well, you need to distinguish between what's building and what's land, because building, do we depreciate? Land? So the cost of land includes, and if we're during building construction, part of land and so on, purchase price, and that's including any existing building that is to be demolished. So when you purchase it, but let's say there's a building on there. What is your intention? To demolish the old building. They call that razing, R-A-Z-I-N-G, razing the building. So that would be demolishing. But let's say I demolish the building and I can sell the old bricks for cash, then that would be a reduction of the cost of the land. So purchase price, including any existing building, surveying, clearing, grading, landscaping, because that's getting the land ready to build on. Costs of raising or demolishing the old building are added to the cost of land. Proceeds from the sale of any scrap. Notice I had an S there, scrap. So old bricks are subtracted. So in other words, whatever I get back, I sell the bricks and I get money, that's a reduction of the cost of the land. So we're trying to separate. In this case, I'm buying land with a building. My intention is to demolish the building. That is part of the cost of the land, getting the land ready for its intended use, which is to build a new building. All right? For example, assume a piece of land with an existing building on it is acquired with the following facts. Purchase price, $300. Cost of raising old building is $50. Sale of scrap from clearing old building is $8. So purchase price of the building, I paid $300, and cost of raising it, getting it ready for its intended use is $50. That's $350 minus scrap from clearing the old building. I got $8,000 for that. That's $342. So $342 would be the cost of the what? The land. Now I start to construct the building. That would be added to cost of building. Why do I care? Because down the road, the building gets depreciated. The land does not. The land just sits in your books. What about a lump sum purchase? Now, with a lump sum purchase, that means I'm buying land and building. And in this case, I'm not demolishing the building, but I'm going to use the building. This is something, an important term called the relative fair market value approach. Relative fair market value approach. And the relative fair market value method is a method we'll use again and again and again. What it says is, let's take the relative fair value. Here's this and this, add them up. So let's say here's 10 and 20 is 30, 1/3, 2/3, right? So that's how we're going to do is relative fair market value. Now, we're going to do this for things like bonds with detachable stock purchase warrants, relative fair market value. So we're going to be using this approach again and again and again called the relative fair market value approach. It says here, if acquire land and building for a lump sum, use the relative fair market value approach to allocate the value between both assets. All right, for example, if property is acquired for $600,000 and the only available information to allocate is the tax appraisal. Now, is a tax appraisal usually accurate? No. It's usually quite often a little bit behind. But it allocates 100 to land and 400 to building. Now that doesn't mean that's how much we're going to allocate, but it gives us 100 is land, 400 is building. But what that tells me is 1/5, 4/5. So 1/5 is what? 20%, 4/5 is 80%. So what it tells me is I'm not using the 100 and 400 as the value, but it helps me to come up with the relative fair market value. In this case, 1/5, 4/5. So what I'll do is I'll take that times, how much did I spend for the asset? I spent 20% of 600 is 120. 80% of 600 is 480. Boom, that's 600. So I'm going to put 120 to land and 480 to building. So you'll see debit land 120, debit building 480, credit cash 600. And that's just, again, using what we call the relative fair market value approach, which is a way of kind of setting it up so we can figure out how much we need to allocate to land and building. Why do we care? Because land's going to sit there, but the building is going to depreciate, which will offset all of our costs of acquiring those assets and the inventory that we're going to talk about later on.